someone asked you where your money actually is invested, would you confidently know the answer, or would it sound like foreign language? Stocks, bonds, and ETFs. They get mentioned everywhere, but most people don't truly understand the difference. Let's fix that without the jargon. Hi, I'm Cecilia Nelson with Nelson Wealth Strategies, and today we're breaking down one of the most common, the most confusing topics in personal finance: stocks, bonds, and ETFs. This is for educational purposes only, not investment advice. But by the end of this video, you'll understand what each one is and how they work and why they exist in a financial plan. When you buy a stock, you're buying ownership in a company. That means if the company grows and becomes more valuable, your investments can grow too. Some companies may also pay dividends, which are portions of profit shared by shareholders. Think of stocks like owning a piece of a business. If the business does well, your ownership can become more valuable. If the business struggles, the value of that ownership can go down. Stocks are often associated with long-term growth, but they can also experience short-term ups and downs, which is why understanding risk matters. Stocks are ownership in a company, potential for higher growth, more volatility, prices can move up and down, that's what that means. When you buy a bond, you're not buying ownership, you're essentially lending money. Instead of owning a piece of a company, you're acting like a lender. The bond issuer, whether it's government or a company, agrees to pay you interest in return of the original amount at maturity. Bonds typically more stable than stocks, loan to a government or company, regular key interest payments, lower growth potential. Bonds are often used to help provide stability and income in a portfolio, but can still carry risk, including interest rate risk and credit risk. This is where things start to click for many people. An ETF, or an exchange traded fund, is a collection of investments, often stocks, bonds, or both, or bundled into one. Instead of buying one apple, one orange, or one banana separately, an ETF is like buying a fruit basket. You get diversification in a single investment. An ETF holds multiple investments, traded like a stock, often lower cost than mutual funds, can track markets, sectors, or strategies. ETFs are commonly used to help spread risk and simply investing, but it's important to understand what's inside of each ETF because not all ETFs are the same. So how do these compare in plain English? Stocks equals ownership, higher growth opportunities, and more ups and downs. Bonds is lending, steadier income, and less volatility. ETFs is a mix designed to diversify and simplify. Each plays a different role, none better than the others. The value comes from how they're used together, based on goals, time horizon, and comfort with risk. Understanding these basics help you ask better questions, make more informed decisions, and feel more confident about where your money is going. Financial confidence doesn't come from knowing everything, it comes from understanding the fundamentals. This is also why thoughtful planning matters. It's not about chasing returns, it's about aligning financial tools with your long-term goals. If this breakdown helped clarify things for you, make sure to like, subscribe, and share it with someone who's ever said, "I don't understand investing."